We've released our results today. It shows 9% growth in profit after tax. And if you look at that, we've seen the impact of the significant drop in interest rates. But the key differentiator of our results in this period is through diversification of our revenue streams. While we get the impact because of the rates coming down, our non-funded income, non-interest revenue, that has actually picked up. And a big component of that is coming through because of the diversifications we brought. Our subsidiaries, asset management business, custody, securities business, bancassurance business, all of these are reporting double-digit growth rates, and so that has helped to cushion the impact on the drop in rates. So that's on the revenue side. Our cost, we've managed our costs, a lot of productivity initiatives that we are running with. Despite the inflation rates, between 3 and 4% over this period, we've only grown our cost by 1%. And in there is because of the productivity measures that we've put in place, which has really helped to bring, some savings from a cost perspective. Our impairment is down year on year by 38%. And this is really coming from the efforts that we've been doing in the past, the focus sectors, which we know can be able to thrive under the current circumstances. And of course, our principles in lending, which we've been able to carry over the years. So as a result of that, you're seeing 1% drop in revenue, cost is only 1% up, impairment 38% drop, and then profit after tax, the one that we report in, a 9% growth. We invested in this business over the years. The latest entrance there is a custody business, which we started in January 2024. Today, that business has about 40 billion of assets under management, picking up, ramping up within a very short time. We started our asset management business several years ago. We've seen, a jump in asset under management from 15 billion to about 30 billion in this period. And then the investment in our bancassurance business that is also picking up despite the drop in lending in this period in our financials, the 4%. Diversification of the focus products, not just on the side of credit risk, which is what is linked to lending, but then looking at other products like endowment, education policy. The bancassurance business has also picked up. Lastly is the securities business from a subsidiary perspective. All of these businesses have delivered over double-digit growth rates just in this period compared to what we had in the last period. Global markets business has been impacted because a big component of their revenue comes from FX. If you look at the macros for the last 12 months, the exchange rate to the dollar you've seen is literally flat at 129. Now there's no volatility. The global markets business makes their revenue, including our other business segments, whenever there's volatility in exchange rate. It has been stable for more than 12 months, which means the margins have shrunk. So the margins we were experiencing 1 year ago has significantly come down. And as a result of that, if you look at our financials, the FX line has come down 14%. Having said that, in terms of the bond income, we have a big component of our balance sheet that has been invested by global markets purely for trading in government securities. Of course, when the rates come down, your valuation of your bonds picks up. And that has actually also been a big contributor to our non-funded income lines. At the moment, despite the drop in rates, you've seen private sector lending growth is only 2%, but we expect that to start ramping up in the second half. So we are looking to lend more to our customers. Reduction in placings with government securities, because we've done a lot of that. So the surplus funding that we have, we've been parking it in government securities. We will now move that to, of course, to lending to the private sector. And from a perspective of impairment, we expect the trend to continue. Low impairment levels, of course, are tied to the fact that advances to private sector has not been significant, so that will continue. On the side of efficiency ratios, our cost-to-income ratio, we don't expect that to significantly change. And lastly is on the side of revenue. Revenue will be tied with what happens, lending now to the private sector, then we should be able to see some changes in revenue. So holistically, expect a similar trend. I don't expect it to be so drastic in the second half, but certainly early next year, we should see a significant change in the structure of the balance sheet.